Okay, in this video, I'm going to go through the second acceptable method to calculate depreciation expense, and it's what we call units of production. And so if you think about the previous example where we were talking about straight line depreciation is like the most common uh, method to calculate depreciation because it's so straightforward and so easy, but it's intellectually inaccurate in some instances. And the perfect example is if you were to use a car or a machine. Um, if you think about, keeping it simple, if we think about a car, right? If I purchase a car for 10,000 and I drive the car, I don't know, something crazy like 70,000 miles in the first year, and then 10,000 miles in the second year, right? We would think that the car would become less valuable after the first year because we drove the car 70,000 miles. That's going to put a lot of wear and tear on the car. And then in the second year, we're only driving the car 10,000 miles, right? So we're not putting as much wear and tear on the car in the second year. So we would think that the second year, the depreciation expense would be less than the depreciation expense in the first year. When we use straight line method, we're basically saying it doesn't really matter how many miles you drove the car in year one relative to year two. We're just going to take the same depreciation expense every year. So units of production, that's basically saying, hey, listen, let's instead of taking, um, sorry, give me 2 seconds. So I could restart this video so that we don't have an interruption midway through that says that my computer's going to die because there's a low battery. But I'm too lazy. I've already gone 2 minutes, and to me, that's 2 minutes that I don't want to live again. So we're going to continue on. But what we were saying before the interruption was that straight line depreciation ignores the actual use. And if we want to record depreciation expense consistent with the actual use, then we would use units of production. Okay. So back to the slides for our textbook, units of production. It's a two-step process. Okay. The first one is starting with the formula, right? So again, it's going to be cost minus the salvage value. And then instead of dividing by time or like the number of years, instead we're going to do total units of production, right? So if it was a car, the total units of production would be how many miles do I think I'm going to drive the car during its useful life? And, like, I don't know, 300,000 miles is a reasonable assumption these days. Okay. Then once I have the depreciation per unit or depreciation per mile, right? Like, in fact, I won't even give an example, but once I have the depreciation per mile, I can then go down to step two and say, okay, how many miles did I drive in this particular period, right? And then I can take the depreciation per unit times the number of miles I drove in the first year, 70,000 in the previous example I was giving on our chalkboard, as opposed to 10,000 in year two. Okay. So let's use the book's example. So again, we're saying the cost of the asset's 10,000. The residual or salvage value is 1,000 at the end of the useful life. Therefore, the depreciable cost is 9,000, right? So over the life of this particular asset, we're saying it's going to depreciate by $9,000. And then we're saying, assume that 7,000 units were inspected during the first year depreciation would be calculated as follows. Okay, so maybe I'm jumping ahead. Maybe what we should say is the useful life in terms of years was 5 years. However, if I'm going to go with the units of production and we're making shoes, maybe we could say over that 5-year period, we anticipate making 36,000 shoes with this particular machine that we're using. Okay. So we could do cost of 10,000 minus a salvage value of 1,000. That would leave us with a total depreciable cost of 9,000. And then we said we would make 36,000 shoes. And therefore, what we're saying in step one is that we are going to depreciate our machine by 25 cents every pair of shoes we make. Okay. Then the second step, we're basically saying, hey, listen, what is the number of shoes that we anticipate using in this particular period? And now I can go back and say, okay, in the current accounting period, we're thinking that we're going to use or create 7,000 shoes. And if I'm going to depreciate by 25 cents for every pair of shoes, then my depreciation expense in this particular period is going to be 1,750. Okay. And the journal entry would be depreciation expense 1,750, and then accumulated depreciation, that is that contra asset account, 1,750. And now, right, we can look at the actual units that we anticipate using each year. So 7,000 in the first year, 8,000 in the second year, 9,000 in the third year, 7,000 in the fourth year, 5,000 in the fifth. Okay. And then, like I said, every pair of shoes that we inspect or create, we're going to depreciate the machine by 25 cents. So here's the depreciation, right? Obviously, in this year, we used the machine the most, and therefore we recognize the most depreciation expense in that year. And then this column is basically accumulating all the depreciation over the life of the asset. And then this is nothing more than the original cost of 10,000 minus all the accumulated appreciation, right? So in year 2024, the original cost is 10,000. All of the accumulated appreciation, 7,750. And therefore the book value is 2,250.